Hey, Dan Passarelli here. How are you feeling today? All right. It is a beautiful snowy day here in Chicago. Before we get started, I would like to make sure that you can hear me. So please go to that questions box and give me a yes if you can hear me right now. Please go to the questions box and give me a yes if you can hear me right now. Alan, Michael, E. Who else? Oh, Robert is here. Oh my goodness, we've got a great crowd today. I love it. Mark, hello, Mark. Alonzo, nice to see you, Alonzo. Brian, Gary, you guys are fantastic, and I love that. All right, today we're going to talk about something super important. Reversing losses with the stock repair strategy. Now, before we get started, I need to point out options are not for everyone. You should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. I see some familiar names here, which I love to see, and I see some new friends here as well. So, for those of you who are not familiar with me, my name is Dan Passarelli, and I am an author of two popular option trading books. Trading Option Greeks is the one I'm most known for. And I am a trader. I've been in the options business for, oh my gosh, I've been in options trading since 1993. That's how you get that gray hair, this gray hair. I traded professionally down on the floor of the Chicago Board Options Exchange. I traded as what they call an upstairs trader. And now I trade in a personal account just like you. And about 17 years ago, I founded Market Taker Mentoring, which is the global leader in option trader education. And I work with a lot of companies in the options trading industry, from exchanges all over the world, really, to options friendly brokers like Firstrade and many more. And I'm a family man. I'm married to my wife, Kathleen, who many of you know, have my two adult children. And I also do some stuff for fun besides trading. I mean, trading is fun, but other stuff besides trading that's fun. I run and I like to eat, which is why I run. I'm a foodie, and me and my family have been all over the world together traveling. We're a musical family, and that's who I am. So now let's focus on the important person here, you. The first thing I want to do is invite you to get some free stuff. If you can open up another tab right now and just simply go to markettaker.com. Market as in stock market, taker as in take what is rightfully yours, two T's in a row, markettaker.com. And when you do, go over here to join free, and we've got some free classes. We've got a free chat room. We've got lots and lots of great stuff for you to enjoy. And that's that. All right. So let's talk about the stock repair strategy. Let's say you own a stock, right? You own existing shares and they've lost value. The stock went down. Now, this has probably never happened to you. How about a show of hands here? Give me a yes if you've ever bought a stock and it went down. Has that ever happened to anybody here? Maybe, I mean, if it didn't happen to anybody, we can just skip this whole training altogether. Oh, it did, Alonzo? Geez, that's so surprising. Anybody else, or is it just Alonzo? Oh, Gary. Oh, yeah. And well, me, right? And Klatt, it's everybody, right? Mark. Yeah, this has happened to everybody. And if you're an investor, The buy and hold strategy means, oh, well, I can hold it. But what happens if the stock really goes down a lot? Like you were just kind of wrong. Well, the stock repair strategy can be used under certain circumstances. And what it does is it's not totally magic. There's a little magic to it, but here's what it can do. You can make back your entire loss if the stock retraces just parts, or about half of what you lost. So that's kind of magical, right? I know it's kind of funny to use the word magic. It's not actually magic, but kind of feels like magic when it works. So let's talk about this now. So you own initial shares that have lost value. What you're going to do to execute this trade is to buy what we call a 1x2 call spread, or a ratio vertical spread that has 2 to 6 months until expiration. What we do is we buy the at the money call and we sell 2 out of the money calls at a strike price coinciding with the price you think the stock can get to. Now, I'm going to reiterate this later, but I want to start with this as the premise before we even go any further. The stock repair strategy works on stocks that have lost anywhere between 20 and 35% of its value. If the stock is down like 5%, big deal. Just hold on to it, for the buy and hold strategy. If you think it's still going to go up, if you think it's going to go down more, just sell it. I mean, 5% is no big deal. I do have some other handy tricks that can help in situations where the stock has lost, 1 to 5%, but that's not the focus of what we're talking about today. We'll talk about that another time. If the stock has lost like 80% of its value, well, you're just out of luck. That either had some bad luck where just some horrible news came out, or it's poor trade management. This is that sweet spot. It serves a very specific purpose. The stock has fallen anywhere between 20 and 35%. Now, there's another criteria here. That is that you think the stock is not going to go down anymore. Okay? If you do think the stock is going to go down more, this is not the strategy for you. Sell the stock. Buy puts. Next criterion is you think the stock is actually going to go up, but probably not all the way up to recoup all your money. You think maybe it could go up like halfway or something over a period of 2 to 6 months. Okay. Does everyone have all the criteria for this trade? Hit that Q&A box and give me a yes if you understand what this can do for you and what the circumstances are, what the criteria are. Mark says yes. And if you don't, tell me and I'll repeat something if you need me to. Gary says yes. Okay, everybody else paying attention? Everybody else got it? If you're fuzzy on something, geez, Louise, Steve posted like a novella over here. Holy cow. Geez. Steve, my friend, for the Q&A, it's very difficult to read like several paragraphs here. So if you want, I'm going to just delete that. If you want to distill it down to something bite size that I can actually answer in a group session like this without like taking 15 minutes to do it. Yeah, no, that's okay, Stephen. Like I literally want to help, and I'm not trying to say, I'm not trying to be critical or anything. But break it down into smaller questions because I'd love to answer it. I'll probably save it until a little later so we can get through some stuff here But please, I'm by no means trying to discourage you from answering questions. I am here for you this hour. Okay. All right. So let's go through a very simple example, and then we're going to get kind of real about it. So we are long a stock, and we all know what long means, right? That means you bought the stock, right? We bought the stock at $80 a share at some point. Could have been yesterday, could have been a year ago. Now the stock is down at 60. How much percent is that? 25%. I beat you. Maybe you beat me. I don't know. You couldn't type it as fast as, couldn't type it before I answered. So the stock's down 25%. So before we even go any further, don't even look at any of this stuff until we go a little bit further here. Here's what you're going to do. You're going to look at the stock chart and you're going to say, the stock I bought at 80 is now down 25% to 60. And here's the question you're going to ask yourself. This is not in the presentation. So if you're taking notes, write this down. This is one of my best tips or tricks that I have. And you are getting it today. You bought it at 80. Now it's down 25% at 60. You're going to look at the stock chart, and this is what you're going to ask yourself. If I didn't own the stock at 80, from 80, and I'm looking at this chart today with the stock at 60, and I'm taking out of my mind any losses. No, that didn't happen. Pretend it didn't happen. I'm looking at the stock chart right now, and I'm looking at the news right now and any fundamental information that I like to look at. I'm going to ask myself, if I didn't own this stock now, because I don't, right? Pretend, would I do it now? Would I buy that stock right now at 60? Because if there's really good support at 60 or really good support at like 58 or something, it bounced off 58, maybe some okay news came out, or, news that disarms any bad news that happened that pushed it down to 60. Would I want to buy that stock now? Not necessarily a screaming buy. If I think the stock's going to go back up to 80 and up to 100 and up to 200, that's a different scenario also. I call this the would I do it now rule, which is kind of a silly name, but a great concept. If I didn't own the stock now, would I buy it now with the information I have now at today's price, 60? And if that answer is yes, and I think it's not going to go up to 80, but maybe can get up to about 70, maybe rise 12% over the next, couple of months. Here's what I do. I continue on and I buy one of the December in this example, but we're going to want to go out like 2 to 6 months. One December 60 call, that's at the money, right? At say $4 a share. And then I'm going to sell short 2 December 70 calls at $2. So I own it at 80. Now it's at 60. So I buy the 60 calls and I sell 2 of the 70 calls. Okay. Now notice in this textbook perfect example that I paid $4 for that 60 call and I sold 2 of the December 70 calls at $2. 2 times 2 is, watch this, 4, right? So I paid $4 for the long call. I collected $4 for the 2 short calls total. So I'm paying 0. So I'm adding no additional risk. There's a key word in that sentence. What do you think that key word is? Additional. This is a scenario where I don't think the stock is going to go down. I'm willing to hold it. I have that much conviction. You know, nobody can see the future, but like maybe there's a lot of good support there, or the news has been out for a few days and you know it stopped going down. So I'm not adding any additional risk. The only risk I have is still owning that original 100 shares that's now at 60. The magic here is that I can profit on the stock if it goes up, and also the option position if it goes up. And because I have this 1/2 or ratio vertical spread that I overlaid on top of the stock, with the stock down $20, I can make all my money back if the stock rises just $10 to 70. How does that work? Hold on a second now. Wait. Okay, so look, here's how this works. I bought call. If calls are out of the money at expiration, they expire, right? They just go away. So here's my question. If the stock is under $60 at the time these options expire, what happens to those calls? Who can be the first to tell me in the Q&A box? Boom! Aslam. It's always on top of it. We got to start giving away prizes. I don't know. I might do that. One of these days, I might do this. All right. Notable, also ran to Dominic and Steven. Very good. You got to be quick around here if you want to beat Aslam, though. I mean, Aslam doesn't mess around, okay? Okay, so they expire. So if these options expire, what happens to the stock? Nothing. The stock doesn't expire. Stock can't expire. Well, I mean, it can if the company goes bankrupt, I guess, right? So you still have those long 100 shares. And how much did you lose on the calls? Nothing. You didn't pay anything for them. You paid zero, and then they expire and go away. So you didn't make or lose anything on the calls if the stock is below 60. You're still long the 100 shares. If it goes down, all you lose is what you would lose if you didn't do this. Okay. Everybody good? Yes. I know you're good. What if the stock is above 60 at expiration, but still below 70? What happens to the 60 calls and what happens to the 70 calls? Who can be first? Can anyone beat Aslam? I don't think anybody can. I think it's impossible. Let's find out. If the stock is above 60 at expiration, what happens to the 60 calls and what happens to the 70 calls? You keep the stock. Yes. Okay. You keep the stock. But what happens to the calls? Boom! Aslam gets it before anybody else. Just leaving you guys in the dust. Come on, man. You got to be fast around here. All right. So, yes. And right, Dominic, right answer as well. Stephen, right answer as well. The 70 calls expire because they're still out of the money if the stock is below 70, right? So the $2 you collected on the 70 calls, hey, you actually get to keep that. So what about the 60 calls? Well, the 60 calls are in the money, right? So that means, well, technically what that means is if we left it on all the way through expiration, is that the 60 call would get exercised because if a long call is in the money at expiration, even by 1 penny, the Options Clearing Corporation will automatically exercise that for you. Okay. Notwithstanding some nuances that could prevent that, but typically that's what happens. So now you're long 200 shares. So what that means, you can see how the slope of this line is that, the slope of this line is sharper. You make money at a faster rate above 60 and below 70. Why? Because you're long 200 shares now. You double up to catch up. First time I heard somebody say that, it's like, double up to ketchup? What does ketchup have to do with this? Is there mustard too? Not ketchup, but catch up. So you double up on your number of shares because you're long those 60 calls. So yeah, you're keeping the $2 from the 70 calls, and the 60 calls are going to be worth something. If it's at $60.50, those calls are going to be worth 50 cents. So you're making money on the shares that you originally owned. You're making money on the 60 call, and you're keeping the $2 from the 70 call. So now this is a tough one. I'm not going to ask you this question. I'm just going to answer it. On the option portion, what would you make if the stock is at $60.50? Well, on the 60 calls, they would be worth 50 cents. You paid $4 for them, so you lose $3.50, but you get to keep 2 times 2, you get to keep 4. So you would be up 50 cents on the call 1 by 2. And you're up 50 cents on the original stock. So if it goes up 50 cents, you make $1. If it goes up $1, you make $2, right? Because you make $1 on the original shares, and then the 60 calls are going to be worth $1. So you lost 3, but you get to keep 2 from the 70 calls. So you're up $1 on that. If it goes up $1.50, you make $3. If it goes up $2, oh, wait, I'm saying $2. Yeah, if it goes up $2, you make 4. If it goes up $10, you make $20. How? Why? Because you made $10 on the stock, right? It went up from 60 to 70. That's $10. The 60 calls are worth $10. Well, the 60 calls turned into shares of stock bought at 60. So you bought it at 60. Now it's at 70. That's another $10. So that's a total of $20. Right? And you paid 0 for the 1 by 2, so you don't make or lose anything on that. You can look at this a number of different ways. We'll talk more about that in a second. So you're long 200 shares. Okay, so now what happens if the stock is above 70 at expiration? I know some folks can answer that one. If the stock is above 70 at expiration, what happens to all this stuff? Now, this one, you got to be, no profit after 70. Yeah, correct. But, well, let me walk everybody through this because it's kind of a long answer. But, right, exactly, right. Thank you, Oz. So why is there no more profit above 70? There is profit, but there's no more than the $20, right? Well, because as the stock went up to 70, I'm long 100 shares, but I'm also long another 100 shares from the 60 calls. And the 70 calls, I'm going to get assigned on those and sell both the original 100 shares and the new 100 shares at 70. So you can look at this a number of different ways. First, let's look at it as 2 covered calls. The original shares, originally bought at 80, but at 60 when I put this on, that's 100 shares, and I'll take one of these December 70 short calls and kind of match it up with the shares. So that's covered call. long 100 shares, short one call. And then these December 60 calls, they got exercised and got turned into 100 shares. And so I'm going to match up the other December 70 call with that one, and that's a second covered call. When a stock goes above the short strike price and is above the short strike price at expiration of a covered call, it gets assigned and the stock gets called away, right? Now I can look at this another way. I can look at this as a covered call, like the long 100 shares in one of the December 70 calls. Here's a covered call. And a bull call spread, long a 60 call, short a 70 call, right? And with the bull call spread, if the stock is above both strike prices at expiration, the 60 call gets exercised, the 70 call gets assigned. I make $10 minus what I paid for that spread, which in this case, is ultimately, well, we can look at that a couple of different ways too. If we're just doing it one by one, December 60 calls, December 70 calls, I paid 2 for the spread. And it's worth 10, so that's 8. But on the 100 shares, it went from 60 to 70. So I made 10 plus the 2, that's 12. It's still $20. Isn't it kind of cool with option strategies when there's a lot of different legs? You can kind of slice them and dice them in different ways and think about it in a lot of different ways. I talked about this last week, right? Didn't I, with the covered straddle and strangle, where it's like when you're going to look at a used car and you look at it and say, well, this side looks good. The rear looks good. I'm going to look under the hood. I'm going to go sit in the driver's seat. I look at it from all these different angles to really understand what it is, right? If it's good. Do that same thing with options, man, every time. So moral to the story is if the stock is above 70, the original 100 shares get sold when the 70 calls gets assigned. The new 100 shares get sold when the 70 calls get assigned. All my stock is gone. I made the $20 that I lost, right? 80 to 60 is 20. I made $20 and poof, everything's gone. And I go like this. I go, I'm out. Yeah, Steven says, actually, overall, you're even, right? Even, Steven, right. And so that is an important thing of this also. You do the stock repair strategy when you just say to yourself, oh, God, man, I can't believe I lost this on the stock. This is so frustrating. If I could only just get my money back, I would be happy. I'm not going to be greedy. I don't need to, make all this profit on it. If I could just get my money back, oh, I'd be so happy. Have you ever been in that situation? Yeah, every single hand in the room goes up. We all have, right? That's what this is for. We just want to get back to even. That's it. And we can't do better than that in this example. So like I said, think of it as a covered call, long stock and one short call, and a debit spread, long call and short a higher strike, or think of it as 2 covered calls, or think about it as stock and a 1x2. So for the 1x2 prices to work, the trade needs to have 2 to 6 months until expiration. You can't do this with 1 week options because the out of the money calls are not going to be worth enough. If you do this with 2 years until expiration, like, what's even the point? Like, you're going to wait 2 years to get your 25% back? I mean, just sell it and buy shares of the S&P 500. That makes 10% a year statistically on average also. So like, it's kind of foolish to do it for any longer time. But the prices will line up if there's 2 to 6 months. And it works best if the stock lost between 20 and 30, 35% of its value. Any less, it's not going to work so well. Any more, it's not going to work so well. The long strike is always at the money, and the short strike is always halfway to reversing the loss. Now, let's talk about that point before we get to the end. Well, let's get to the end. We only make this trade if we're expecting it to halfway a halfway retracement. So let's talk about that third bullet point here. What does at the money mean? At the money means the stock price is the exact same as the strike price. There are about 4,500 stocks that have options listed on them. How many of them do you think right now has has an option that is exactly at the money? Exactly. Right exactly at a strike price. 0.5%, that's a pretty good guess. Aslam, none, yeah, rounding to the nearest whole number, zero. Right, barely any, right? So we're never going to trade it exactly at the money option. It's always going to be either a little in the money or a little out of the money. What I gave you is the perfect textbook example, but life is not perfect and trading is not textbook. So we're going to go close to the money. And likewise, we're never going to find a strike that's exactly halfway to reversing the loss. I mean, you might have lost $20.31. We're not going to find a strike that's, $10.15 above where it is now. We're going to just get close. We're going to do a little bit of rounding. So we kind of have to use a real example here, okay? So this is a stock, and this is not any recommendation or anything like that. This is just, I want you to, when you see this in real life, to be able to identify it and therefore be able to use it. So this is just an example, not at all intended to be a recommendation. So let's say in this stock, I bought it at $100 a share, and gosh darn it, I had terrible timing. We had that August 5th drop that we had last year, but it bounced right back, and we're thinking, hey, life is good. Okay, I'm back in business here, baby. And then, oh, what do you know? A few days later, bad earnings or whatever this was happens. And, it's making some higher highs and some higher lows. We've got some hope, some hopium, and it gets up to 90. We're like, okay, this might not be so bad. Oh, darn it. It's down at 84 again. Oh, I'm just so distraught. Man, I wish I could just get out of this thing, get my money back, and I would be happy. But I don't think it's going to get back up to 100 anytime soon. Here's what we do. If we look, there's some support down here at about $72. It's like a little bit of a higher low sort of scenario, a little bit of a diagonal line. I like the really horizontal line, but we could definitely say, 72, 71, we've got some pretty good support there. I think since we did have some higher highs and higher lows, but then a pullback, we probably won't break support again. The stock still has okay earnings or whatever, hypothetical example, really. I'd be willing to hold on to this and ride it out. But man, if I could just get my money back, I'd be tickled pink. I do think in this hypothetical example that this stock could make it up, maybe up to 92 or something. Probably test this again, but that's probably my best case scenario. Oh, hold on one second. Hold on one second. Yeah, that would be my best case scenario, is that it goes up to 92. Um, so what am I going to do? Well, I remember that one cold day in January when I was bundled up in front of my computer doing some self improvement, learning from this Passarelli guy, the the stock repair strategy. And let me think, how does that work again? Oh yeah, these are the exact criteria for a trade like this. In fact, I think I'm going to do it. Let's see if that works. So, because I don't plan to sell my shares, I'm happy to get out with a full refund if the stock rallies halfway to my original buy price. Here's what I can do. Recall that I originally bought the stock around 100. Now it's at 84 in this hypothetical example. So I can buy the at the money calls. That's what Passarelli said on that cold January day. Buy the at the money calls. Well, let's see here. The stock's at 84, so I'll just buy the 84 strike. There is no 84 strike in the May 16th expiration. But maybe there is in another expiration. Well, let's look at the May. That's what I put in the presentation. Then we'll explore some other things in a second here. I've got to pick the 82 and a half strike or the 85 strike. It's a little closer to the 85 strike, and I could have done that. But I figured it could probably get up to about 92-ish. So 92 is probably the strike I want to sell. If I bought the 85 calls for 8 or whatever and sold these at, let's just round it to 5 or whatever, I'd actually bring in a credit of $2, which is nice. It's nice to bring in a credit. It actually gives me $2 more cushion to the downside. But the difference between 85 and 92 is only 7.5. So I don't make as much on that spread. So I actually opted to buy the 82 and a half ones in this example. And I could the markets are a little bit wide in this one. So I could probably buy those a little cheaper, maybe $9.40. And the 92 and a halves markets it's not that wide, but I might be able to do a little better, say $4.95. So back up to the top right corner here. If I paid $9.40 and collect $4.95 2 times, which is $9.90 total, I actually take in a 50-cent credit. So that's pretty close to zero. I like to get it pretty close to zero. So let's look at how this looks. Well, actually, no, before we do that, let's take a look at why I chose May. Research and tools, options. Oops, nope. Sorry. Trading options. OKTA. Get option chain. And we're going to have to do all. Well, maybe we can do out of if we do out of the money, there's actually there's dollar strikes in the January 17th that has at the time of this recording has 3 days till expiration. So I've got to show if I were to sell the 92 and a halves, there's 0 bid. So I can't do that with the January 17th expiration. What about the January 24th expiration? They're dollar strikes too. Well, I could sell the 92 strike, at 10 cents. So I buy these at say $1.50, sell these at 10 cents. I'm still paying $1.30. I'm investing more money into a losing trade then. What about here? Let's go out to February. How about February? That might work, right? February. Oh, they still have dollar strikes. So I could pay 260 for the 84 calls and collect, oh, well, these weeklies that have like 3 weeks until expiration, they've got like really wide markets. There's zero bid. Can't do that either. Well, I think February 21st is a monthly expiration. Oh, but the monthly expiration only has $2.50 strikes. So there's no 84 strike. I could buy like the 85 strike at say 290, sell the 92s at 85 cents, which is $1.70. So I'm still investing $1.20 into the trade. Oh gosh. Well, what did Passarelli say that one day? Well, he said this tends to work with 2 to 6 months until expiration. I'm still, this is like 1 month. It doesn't really work on these shorter term expirations because you just can't sell the out of the money call for enough to cover the cost of the at the money call. That's why it's 2 to 6 months until expiration. And so that means the move up to 92, like if it happens tomorrow, well, this might not be the best strategy. If you think that it can just sort of grind higher, then that's when this becomes an interesting strategy. So, okay, probably if we go to February 28th, that's still not going to work, right? That's just like 5 weeks out or something. Buy the 84 calls at, oh my God, these markets are terribly wide. Ugh. But why are they wide? Because they're weekly expirations with 5 weeks until expiration. There's just not, this column right here is the open interest. There's no open interest. Like nobody trades this. I mean, the January 17th, there's tons of open interest. Even the January 24th, there's a fair amount of open interest. But February 28th, like that just got listed yesterday if you're watching this live. Nobody's trading it. So the markets are consequently wide. But if I go out farther to the May 16th, which has 4 months until expiration, 121 days, now we're on to something. And instead of looking at the out of the money, I think I have to look at all. May. $121 days till expiration. So, well, here is where I can buy the 82 and a halves for, whatever. These are live prices now. Call it, well, 890. Sell the 92 and a halves for 550. Well, or 950. Taking a credit of 60 cents. Do you see how the ratio between the at the money and the out of the money gets massively better when there's more time until expiration? John, just a few minutes ago, asked how many months to expiration is the better option pick, 3, 6, or 12? Well, never 12. I mean, 12 starts to be, who knows what's going to happen in 12 months. Like our objective is let's get our money back as fast as possible and just be done with this trade. So 12 months, I don't know, that's a long time. We want to keep it as short a duration as possible, but we got to consider two things. One, how long will it take for the stock to get there? And two, how far out do we have to go for the out of the money options to be big enough relative to the at the money option, or if I sell two, it covers the cost of the at the money. So we've got this balance, right? We can't go too short because the prices won't work out. We don't want to go too long because I don't know what's going to happen in a year. I'd probably just rather cut bait, take a 20% loss on this, and just find a better stock to invest in if I got to wait a year. So if I can go 2 months, good. Up to 6 months, good. That's the sweet spot. But also, I mean, if I think the stock is going to go on a tear and it's going to make it that much by the end of next week, I don't do this. I just wait and maybe do it then because I'll be able to buy that spread for a lot cheaper. You got to really kind of play with it a little bit, John. Very good question. Okay. So I figured I'd kind of give you a live example of how to look for this on the Firstrade platform. All right, so let's get back at it. So this is what I selected, and this is what we get. Originally bought stock at 100, now it's at 84, so it's down. It's just down 16%. So that's, it's not a ton. Is there? Alonzo, talk to the good people here at Firstrade. Maybe if somebody's listening in, they can reply back to you, okay? Because it's just going to vary. It's just going to vary. Okay, so if I buy the 82 and a half calls at 940, and I sell two of the May 92 and a half calls at 495, I take in a credit of 50 cents. Again, would I like it to be zero? Sure. Taking in credit is kind of nice because here's what we end up with. Oh, we actually, I'm going to, on the fly, change this just a smidge. To make it just a little bit more accurate. Okay. So this is the line I changed because if the stock is below, oh no, I actually made that less accurate. Sorry. Gotta think for a second. There we go. Now I made it accurate. Ish. Ish. I like doing things the right way, in case you haven't noticed that about me. I like you to have the best information. If you're gonna invest your time in my class, it's gonna be a good class. Okay. So, if the stock goes down below 84, well, you can lose money, right? But we actually get an extra 50-cent credit. So my real break even becomes like 83 and a half. Okay. And if the stock is above 82 and a half at expiration, those 82 and a half calls will have value. They'll have $1 of value to them. So if we're below 82 and a half, we're still long the one. Well, here, let's do this. If we're below 82 and a half, we're still long the 100 shares. But we're long it not at 84 anymore, but effectively at 83 and a half because we got that extra 50 cents. If we're between the two strikes at expiration, then we're still long from 84, but we also exercise our 82 and a half calls and we're long another 100 shares. So right there, we're long 100 shares, right? Okay. Between the two strikes, we're long 200 shares, right? Okay. If we're above 92 and a half at expiration, what happens? Well, we're still long the 100 shares. We're still long the other 100 shares from 82 and a half, but both get called away when the 92 and a half calls get assigned. So the most we can make is from 84 to 92 and a half, which is 7.5, plus from 82 and a half to 92 and a half is 10, plus the 50 cents, we make 18 and a half dollars. I should have put the math on the screen. It's hard to do math when you're giving a presentation. You think about all these different things. But, that's basically the gist of it. So this is like a realistic example where it's not a perfectly at the money strike. We've got to go through different expirations to see which one fits the best. There's not going to be a perfectly in the middle of where we bought it to where the stock is now strike. It's not going to work out perfectly, but the concept still holds true, where between the two strikes, we double up to catch up. And once we make our money back, we're back to even. And we do. In fact, we actually make a little bit more than our money back. We make 1850. We're down 16 bucks, but we make 1850. And why is that? A couple reasons. One is because we're starting out at 82 and a half. We're starting out with a strike that's slightly in the money. So we get the benefit of the long call from 82 and a half, not 84. And we get the 50-cent credit. Does that all make sense? Give me a big old yes if that makes sense. And if you think that when you see a situation like this, that you'll be able to recreate this strategy and use it. Give me a yes for that. Osm says yes. Good. Gary says yes. Good. And if not, Dominic's, okay, good. Dominic, Steven, I was getting worried there for a second. And if not, so Firstrade archives all these on their YouTube channel. So you can just go to YouTube and search Firstrade and scroll down until you get to their channel and then click on videos and you can find this one and you can review the information because it's a lot, like learning how to buy a call is easy, right? Learning how to buy like a vertical spread, pretty easy too. You start getting stock and then a one lot and a two lot and you start really having to think about stuff. So yeah, if this doesn't 100% grasp, I don't know how long it takes them, probably by the end of the day or by tomorrow, just go to their YouTube channel and review it. Or, you can always reach me at dan@markettaker.com. Or like I said, you can always just go to markettaker.com, click join free, join our chat room. You'll have to request that with Kathleen. And hit me up in our chat room or ask me, one of our other coaches, or some of the other traders on there that share trade ideas. Steven says, glad I watched this. My strategy was going to be to double down. Yeah, this is doubling down, but with no risk or practically no risk. The trade-off is you only get your money back. You don't get any for pain and suffering with this one. Okay. You just get indemnified. All right. Final questions? All right. Good class, good interaction, good questions. You guys are a smart group. I will see you in 1 week when we talk about, my favorite subject ever, trading the wheel in your retirement account. Oh, you're going to love that. All right. I will see you next week. Have a great rest of your day. This is Dan Passarelli. Trade smart.